A big myth is that bedrooms add significant value. Once you get over about 3 bedrooms, it all kind of gets lumped into square footage.
This duplex from them was ARV was I think 190,000, and then we did it and it was like I think it came back like 110.
The data's saying the property's worth 410. It's probably safe to, be around 410,
Right.
if not even more conservative. Then run your numbers from there. If the deal doesn't work out at that point, it didn't work out.
Yeah.
But at least you're not getting yourself into a bad situation. The biggest mistake I see is they're trying to justify a price.
What's up, everybody? Welcome to another episode of the Real Estate AF podcast. Today we have a special guest, Kendrick Spencer. Kind of a little, backstory on how this came about, is I got one of your ads for your comping SKOOL community. It caught my interest right away because that's something as an investor that obviously makes a difference in my life, and being the best at that, or at least better than I am now, can be the difference of losing or making money. So I definitely want to be good at that. So why don't you tell us a little bit about yourself? Tell us even about your community. We'll love to promote that, and we'll get started.
First off, I'm super happy to be here
Yeah.
with you, Rio, and I appreciate talking to you about it. I'm also, I'm a certified residential appraiser in the state of Arizona. And in 2017, I went to my first real estate seminar and I caught the bug. And so I just got so excited about real estate, and I was trying to figure out how to make money in real estate. And I went to this big seminar and they talked about wholesaling, flipping, making tons of money in real estate. And they would always mention, the way you make money is you have to know the ARV, or the after repair value, but they never taught how to actually find the ARV. So I spent a bunch of years, probably the next year, trying to figure out how to get into real estate, but I was scared because I didn't know how to value a house. And that's when I stumbled across another appraiser. He ended up training me, and I was excited because I found a career that I would get paid to learn how to properly value houses, right? So that's kind of how I got started as an appraiser, kind of just stumbled into it. And then I have this affinity for real estate investors. I think they provide great value to the market, just to everybody in general. And so the more I've been in the industry, the more I've worked with investors, I've noticed that there's this big gap in education where everybody talks about marketing, how to find deals, even how to dispo deals, how to fund deals, but no one was talking about how to actually know if you have a good deal.
Right.
And so this is that's where I found my expertise kind of coincided with that missing piece inside the education. So my goal is ultimately just to help real estate investors learn how to properly comp houses so they can ultimately make more money or mitigate any tough times that may come.
Right on. And, I mean, you said something. I mean, that's a key point is, the lack of education and knowing what a good deal is, and that, I think, for me, because like I said, my background is building home service businesses, but I've been interested in real estate for a lot of years. I mean, probably 10, 12 years. But that was the thing that kept me. I'm like, I don't know what a good deal is. I don't know how to do this. Yes, I understand comping. I understand the basics of it, but still it's like there's such a variable there. And now that I do own real estate, there's these also variables in from, let's say, one appraiser to another appraiser. And so those things, that's scary, because again, that could be the difference between making and losing money on a deal. So I think let's just start from the beginning. And I think a good way to do it is even with your course. So why don't you just briefly explain, what is comping?
So the comping essentially is just knowing the value of a property, right? And there's several values that people can come up with in real estate. There's an ASIS value and an after repair value. They're the most common values. And as real estate investors, a lot of the times you want to know what the after repair value is, because people are looking to add value into a house, right? And so comping is essentially, there's a science to it, there's a bit of an art to it, but there's a lot of principles that if you follow, you can typically find within, it's funny you say that because, you can get an appraisal on one property and you have 2 different appraisers come to it and their values could be significantly different. Yeah. At the end of the day, value is always just going to be an opinion.
Sure.
So on an appraisal report, it says, the appraiser's final opinion of value.
Yeah.
So there's always going to be a little bit of discrepancy. But for the most part, if you know the fundamentals of comping, you can typically find the value within a certain percentage, right? 5, 10% of what it actually is, which is enough, usually enough buffer to make things work. And so I always start off by, so I created what's called the comping commandments, and it's basically just a checklist or a system that investors can follow to find the value. And it's based on 5 principles, the 5 largest principles in determining value. So the first one is just understanding the overall market and what market trends are going on. The second is understanding locational differences in areas from, there's a lot of talk that you can never leave a subdivision when you're comping, or you have to find similar subdivisions. So understanding locationally where the most similar houses are. The third one is understanding how size plays an impact. So lot square footage as well as square footage of a house. The fourth one is just the qualities of the house. So condition, if there's special amenities, pools, storage units, horse facilities, things like that, and what those the impact those have on value. And then the last one, which is the one that appraisers have this is where appraisers spend most of their time training, is learning how to adjust the comparables, to adjust the value to be more similar to the subject property or the house that you're trying to invest with.
So explain that a little bit, because that's interesting to me. I didn't really understand that at first until I was looking at your course.
So adjustment, the easiest way to explain it is, so no 2 houses. Now in Arizona, maybe it's a little different because we have these big tract communities where there's a lot of similar floor plans. And obviously those are always going to be your best comps. But in most cases, no 2 homes are going to be identical. They're not going to be exactly similar. So the adjustment comes from taking the comparables that you've deemed best, and there's still going to be variations in those comparables compared to your property, and then adjusting those to make them as similar as they can be to the subject. Okay. So if those comparables, so say they sold for somewhere between $300,000 to $315,000 each one of them, and say they have slightly different square footage, maybe different bathroom counts, maybe a few small amenities. If all these properties have the exact same stats, I call them as the main house, exact same square footage, exact same amenities. Yeah. If those were all the exact same, where would the price that they sold for end up compared to your house? And then that gives you a pretty good idea of what market value would be, is if all those houses were exactly the same as yours. And so deriving those adjustments is where appraisers make their money. That's where we spend most of our time, is going through market data and doing a bunch of nerdy regression analysis type stuff to actually find the contributory value of each individual feature of a house.
Got it.
So that's where the adjustment comes down, and it is the most complicated to understand. But I think as investors kind of get a grasp around adjusting the houses, that's kind of where that next level comes into play, of being more certain about your value.
Okay. I want to go back to something you said real quick, so you're talking about different types of comps. So you're talking about as is, ARV, are those is that, say that's a different form, like they're completely different, and is that something, say, an investor should be asking for one or the other? How does that work?
So the principles to derive the value are going to be the exact same. It just comes down to what comps are you going to use. So for an as-is value, is very typical in traditional lending appraisals. So when a bank is going to go lend on a house, they're normally looking for, what's the property worth today, and is it worth as much as they're paying for it, and will my investment be sound? That's basically what the bank's asking for. So I think it's important to come up with the as-is value for investors. But a lot of times investors are probably trying to look to pick up properties for less than the as-is value. Yeah. So the principles of finding the value are the same, but if I'm looking at an as-is value, I'm maybe putting more weight on the condition of the property. So say I'm doing an appraisal on a house with significant deferred maintenance, maybe in disrepair. I'm going to try to find other comparables that have sold in similar condition, because that gives me an idea of, hey, the market's willing to pay this much for a house in disrepair. Right. Where the ARV, I would use the same principles, same square footage parameters, same location parameters, but I would then go to the top of the market and see all the homes that have been updated and use those as comparables compared to homes in maybe in worse condition. So that's the main thing I tell investors. If you're looking for your ARV, the first thing I always do is I just go look for what sold for the highest in the community. Because if you can kind of see where the ceiling is in the community, you can always work your numbers back from that. And so that's where I always start with ARV. I just go to the highest, because typically the homes that are most updated are the ones that sell for the most in an area.
I mean, what would you say you see where investors make the most mistakes when comping?
That's a great question. And that's honestly where this idea of creating affordable education for people, for investors, came from, to teach them comping. Is I'm on a bunch of wholesaler lists, and I get properties sent to me all the time, and the wholesalers would send their list of comps, and they would
always so far off.
It's the funniest thing. I always love looking at them, and just it always gives me a good chuckle.
So I just bought. I don't mean to cut you off. So the property I just closed on last week, and these are St. Louis, lower end, Section 8 affordable housing type stuff we're doing back there. But this duplex from them ARV was I think 190,000. And then we did it, and it was like, I think it came back like 110.
Yeah.
I'm like, oh, dude. So you never trust a wholesaler.
No, you never trust the wholesaler, and I think that's kind of a side tangent, but I was like, I think that's why wholesalers have gotten such a bad rap. They've never learned the fundamentals of valuing, so they get deals locked up too high, ultimately screw up a seller, or screw a seller, and screw up a situation. So the wholesaler gets the bad rap in the community. And so that's the biggest mistake I see, is they're trying to justify a price. So what I mean by that is they'll pull comps, and this is a true example of when I saw it. Came over in Mesa, and the comps were actually pretty solid, and it was 410, 405, and then maybe like 415. So right in that 410 range. And then on his sheet, he says ARV 450. And it's like, yeah, that'd be awesome if it was, but it's like, you just gave me data that says it's 410, so that's the biggest mistake I see wholesalers make. I've even seen fix and flippers normally have a little bit more experience, just a little bit higher risk, but it's a mistake I've seen them make too, is everybody in real estate wants to make money, and there's absolutely nothing wrong with that. But when you fall into the trap of trying to justify, hey, I think I could sell this for 450 to make, you put that target money of how much you want to make
very dangerous
on there, and then that's when I start seeing the mistake. If the data is saying one thing, if the data is saying the property is worth 410, it's probably safe to be around 410, if not even more conservative. Then run your numbers from there. If the deal doesn't work out at that point, it didn't work out. But at least you're not getting yourself into a bad situation. And so in 2022, I bought a flip in May. So May 2022, interest rates went up the end of May. So I bought it 2 weeks before rates went up. But luckily, we ran our numbers conservative based off market. And we didn't make money on the deal, but we didn't lose our shorts on the deal either. And so I always use that as an example of like, hey, we were able to run our numbers good in one of the most interesting markets we've seen in a while, where prices were coming down pretty rapidly for at least 6 months. And we were still able to get out of the deal without, losing our house, our life savings, everything. And so
that's nice.
So that's the biggest thing I would say. Don't justify your price. Like if you know the fundamentals of comping, find what the market's saying the house is worth, and then that's what it is. They'll try to come up with a different number.
When you're looking for a flip, like you personally, you're going to do a flip, do you use something? Do you use the 70% rule? What are you looking for? What are your parameters for a flip?
I always work back. So I find ARV first, and then I just work backwards. So if ARV's 400, and then I'll take out all my holding costs, realtor fees, closing costs, and then from there I'll typically take out renovation costs plus desired profit. Then whatever number that gives me. Normally it's 60 to 70%. Typically, that's kind of my process. Nothing crazy. But I always just start making sure that I have the ARV solid, and then from there, it's pretty easy to reverse engineer. If people are scared of construction costs, it's pretty easy to get a quote. Just hire or just have a contractor come give you a quote, and then I just work backwards from there.
Right on.
Yeah.
All right. In your course, you talk about the law of substitution.
Yeah.
What is that?
So the law of substitution is the underlying principle of comping. So I always use the example of, say you have a hot date night with your wife, and there's two movie theaters right across the street from each other, and the price of tickets is the exact same. So you can go see the new Avengers movie for $10 at each place, but one place has and everything's the same on these two theaters. Concessions, popcorn quality, everything's the same. But one place sells their popcorn for $7. The other place sells their popcorn for $10.
Right.
You're obviously going to choose the place that sells the cheaper popcorn if the experience is exactly the same.
Yeah.
So that's the law of substitution. So that in an open and free market, no one's going to pay more if they can get the same for less. And so in real estate, it's the same principle that determines comping. Is if you're going to go list a flip that you just did, and there's other active listings on the market for 300 that are the exact same to your house, why is somebody going to pay 320 for yours?
Yeah.
Right. So understanding the law of substitution helps you make those decisions better as far as comping goes, of knowing, hey, here's what my competition is out there. The biggest thing is thinking like the end buyer. So whoever's going to buy that property, when they're shopping for their houses, when they're out with their real estate agent, they're all excited, they're trying to find their forever home for their family.
Right.
They're not going to go pay more for a house that they can get the same of.
Yeah.
And so running numbers with that mindset of, hey, there's going to be competition on the market. My house isn't anything special. Really just removing that emotion from the transaction will help people competitively price their homes when they go to sell, but also as you're running your numbers, allow you to see the market from a little bit different, a different lens, understanding those are the behaviors of typical buyers in a market. So that's kind of what the law of substitution is, just understanding that there's going to be competition and people aren't going to be willing to pay more for your house if there's a similar substitute on the market.
Yeah, makes sense. What do you think if you only had access to, let's say, the data for three things when you're comping, what would those top three things be, the most important thing?
So two that everybody has access to is just understanding what's going on with the market. So is the market increasing? Is it going down? Is it declining? Is it stable? What's going on with the market? So that's the first thing.
But I want to dig into that a little bit. So, you say everybody has access, but like, how do you see that data?
So a website I really like is FHFA, so the Federal Housing, the acronym, whatever it is. But so I really like that website. They have so much data on all the housing. So they'll do a report every quarter of the appreciation in every market in the nation.
Okay.
Pretty easy place to go. Zillow also gives appreciation numbers. So just a quick Google search on Zillow will also let people know. Another one is just ask your realtor, whoever your realtor is, ask them to pull just all the closed sales so have them draw a map around Mesa, and then have them pull all the closed sales in the last year in Mesa. So have them go pull everything for 2024 that's closed. And then there's a button they can click on median price, and it will just spit out, hey, here's been the median price in 2024 in Mesa. And then go back to 2023, pull the median price, and then you can see the year over year change there. So those are just a few free, easy ways for people to see appreciation trends in markets. The next thing I would recommend people do is just really learn locationally where similar subdivisions. And honestly, the easiest way to do this is just look at a map and look at land uses in an area. So it's pretty easy to see if it's a big tract community, and lots are smaller and all the roof lines look the same, versus if there's a subdivision right next to it that has bigger lots and maybe different roof line styles. That's one way. So typically looking for different subdivisions like that, and then finding subdivisions that maybe model what your subdivision looks like within a certain radius. So typically a good rule of thumb is within a mile. In some areas, it's required to go out from a mile, but if you're in a big metropolitan area, probably staying within a mile is pretty safe. So those are the two main variables that I would say really understand if people are really serious about getting into real estate. Understand market trends, talk with local experts, find an appraiser. Some appraisers are grumpy, but then there's a lot of appraisers that are friendly, are willing to talk. Talk to them. They see an appraiser on average probably sees between 20 and 50 transactions a month compared to the typical realtor who's maybe seen one every other month, right? So they have a better feel of the market. So interview them, interview top performing agents, other investors, people that are in it. If you're a newbie investor looking to really understand a market, I'd say go interview those professionals. A lot of them are willing to give their time and talk to them. So those are two things that are just public information that probably have the two biggest impacts on value, with market and location. But then once we get into just the house itself, say we don't have a ton of information of the house, say we're just trying to find ARV. So if you're trying to find ARV, you don't necessarily need to know the condition of the house right now.
Yeah.
So the biggest things is getting an accurate square footage. So that's the biggest individual factor for a house that's going to determine the value. So obviously, typically, right, a bigger house is going to be worth more than a smaller house.
Is that something real quick
Yeah.
that, because I've seen on a couple of the houses that I purchased, what it shows you, the square footage isn't actually square footage. Do you guys as an appraiser, do you always verify that?
Yes. So I measure every property that I do an appraisal on.
Okay.
So I have a laser measuring device on my phone, and then I measure it. We have to go through schooling and training and how to measure a property accurately.
Mm-hmm.
So a few tips when it comes to square footage is if it's if it looks like a unique house, it's probably worth calling an appraiser. Most appraisers for $100, $200 will just come measure the house. They won't do an appraisal, they'll just measure it for you, get you an accurate square footage. So that's one tip. Another tip is most counties across the nation actually have a county sketch in their assessor page for each property. Mm-hmm. So I always compare the county sketch to what's actually the house actually is. So that's if it's off, then it's probably a red flag to go get a measurement to make sure you get the accurate square footage. The other mistake I see a lot of people make, we don't deal with it a lot in Arizona because we don't have a ton of basements, but across the nation, basements and above grade GLA, so anything above the ground.
I just had this.
Yeah.
In my property in Illinois.
Yeah. So
I had no idea.
Yeah. So they'll separate the two. Yep. So anything above grade. Arizona's a little different because basements are cooler. They're a little bit more expensive to build in Arizona. So typically, basements in Arizona still get quite a bit of value. Most other places in the nation where foundations are the basement, the value will be, most places, 50%, if not more, less than what's above the ground. Yeah. And so make sure that when you're comping something with a basement is that you're pulling your comps based off what's above the ground, and then try to find other homes, obviously, with similar above grade square footage with basements as well. So that's a big mistake I see where people will say the house is 2,000 square feet with a basement. They'll go compare it to a house that's 2,000 square feet all above grade, which is going to be a little bit more to build, and people are normally willing to pay more for everything above grade. So that would be probably the biggest individual factor of a home that I would say make sure you get that right. And if you get that right, then the value's a little bit more sure. But so that would be the biggest individual factor, and then make sure a big myth is that bedrooms add significant value. And once you get over about 3 bedrooms, it all kind of gets lumped into square footage. So if you're finding a house with similar square footage, but say you have 3 bedrooms in your house, one of your comps, same square footage, but they fit a 4th bedroom in there, that individual bedroom's probably not going to have a ton of value add. Okay. But put more weight on bathrooms, because bathrooms just... more bathrooms, the better. Sure. Everybody wants more bathrooms. So I would say those are probably 2. And then probably locking in what additional amenities the house has. So does it have a pool? Does it have significant landscaping? Does it have outbuildings? Stuff like that would probably be the 3 biggest individual factors to look at in a house if you didn't have a ton of data. If you have those 3 things, you can normally get within the ballpark of where value might be at.
In terms of, I would say as a whole, like the whole United States right now, what do you think about the current market? And then because we're here in Arizona, what's your thoughts on the current Arizona market?
Yeah, so from what I've seen, in Arizona, I do a lot more studying in Arizona, so I can speak more on that. What I've seen across the nation is things are fairly stable. And it's been that way. So we obviously had crazy appreciation COVID years. Yep. So 2020, 2021 especially, first part of 2022 went crazy. rates went up 2022, then the market came down about 10% in 2022 from June to December, but we'd already seen about a 10% increase the first half of 2022. So it just kind of canceled out. And then I thought it was going to continue down, but it just kind of stabilized. 2023, really 2024 stabilized. If anything, the market tried to creep back up a little bit in 2024. So across the nation, I'd say it's pretty safe to say it's fairly stable. What I'm seeing right now in Arizona, and I haven't looked in other markets, but in Arizona, I was actually looking this morning, is I think a lot of people got overly optimistic after the election. I think people thought things were going to go, that, we were going to have a new president in office and, everything was going to be crazy. And so a lot of sellers that were maybe on the fence, I think are listing their houses now, or at least the last few months. So we've seen this huge increase in inventory. Yeah. So as of the end of February in Maricopa County, we had about 30,000 active listings on the market, but we've averaged only about 5,500 sales per month.
Jeez.
With about 10,000 new listings coming on the market each month. So what I'm a little skeptical about and keeping an eye out for, and I'm not saying this is going to happen, if rates come down, it throws a whole nother variable into what's going to happen. But what I could see happening is everybody that the last 2 years has been sitting on the fence to sell their house lists, and then we have this increase in inventory with not enough buyers all of a sudden, and that would drive prices down.
Yeah.
Just 'cause the typical buyer would have more options, and then to be competitive, back to the law of substitution, to be competitive, people would have to start dropping their price.
Yeah.
And so that's what we're seeing as of the end of February, is a lot of inventory, not a ton of transactions going on, about double the amount of new homes being listed each month than what's being sold in Maricopa. So
yeah, I've had to do a couple drops on my Tucson house, and I'm being aggressive because I want to get it off the books. But it's surprising because I have two houses down in Tucson right now, and super good neighborhoods, like the best neighborhoods down there, and one's still in the rehab, but the other one, a couple drops. I'm like, man, I was for sure it would be gone within 30 days, and we're probably 40 days right now.
Yeah,
something like that.
Yeah, that's another big data point I just looked at, is days on market has increased about 10 days every month for the last 4 months. So I think we're sitting about like 58 days on market, I think is what it was at the end of February for the average in Maricopa County. So, I mean, it makes sense when you have more inventory.
Yeah.
Just things aren't moving as quick with less buyers in the market. So that's something I would keep an eye out for as a kind of a warning call to investors, is to keep an eye out for inventory in your markets versus the amount of transactions, and that gives you a good gauge on demand, and also seeing what's going to happen with prices.
Yeah, no, I agree. In terms of, I guess we'll talk about your course a little bit, because again, I think it's really needed in the marketplace right now. Again, like as soon as I saw it, I'm like, I'm going to do that, and then just how I operate, I'm like, I'm going to hit this guy up and I'm going to get him on the podcast and start the conversation, start a relationship, because, I'm not going crazy here in Arizona right now. Everything's so expensive, but, I still, when I'm ready to, you're going to be the first guy I call up. But in terms of your course, you have the mindset part of it.
Yeah.
And I think that's important to talk about, because that's a massive part of it. I think that's a big thing that we've already kind of talked about. It keeps people out of real estate, because especially when you're new to real estate, you're thinking about these numbers are so big, and then what if I screw up, what if I do something wrong, what if something goes wrong? But so you definitely have to have a strong mindset to jump into real estate. So why don't you talk about that a little bit?
Yeah, I think I've talked to other appraisers about this, and I always bring up, like, hey, here's the mindset you need to have with comping, and it's always greeted with a little bit of resistance that, hey, it's just numbers, you don't need to have a mindset when it's involved to it. And I would disagree with that, because I think even if the only thing that people that joined my course, if the only thing they got from it was trying to think like the end buyer and having that mindset of, this deal isn't necessarily for me. Yes, I'm going to make money in it, but I'm also making a product for somebody else to purchase. And if you can think like that end buyer, that's that's going to get long-term financing on it, that's going to move their family into the house, that's going to ultimately get an appraisal on the house, having that mindset of loan, of thinking like the end buyer, I think would save so many people, because you're looking at it from somebody else's shoes, right? It takes a little bit of the emotion out of it for the investor, because you're almost putting it onto somebody else in your mind, right? Of hey, somebody else would be willing to pay for this house this much based on the data. So I think that's just the biggest piece that people could take away from the course, honestly, is just thinking like the end buyer, what the end buyer, and whether you're fix and flipping a single family home, or you're looking to do the BRRRR method and you're putting a tenant in there, like everything always leads back to some type of long-term financing.
Yeah.
Eventually, right? Even if you get into the creative deals, eventually those are going to get dispoed into some type of long-term financing. So I think having that mindset of the market doesn't necessarily care about me.
Right.
It only cares about the data, the numbers, and ultimately what the buyer's gonna do, understanding that behavior. And I think just having that mindset, one, takes a little bit of pressure off, and then two, I think it just allows people to make better decisions in the journey.
No, that's an important point, especially for me, because I'm a creative. Like, I love the design process and figuring that out. And I think I got on one of my first ones, I liked the house, I liked the area, like personally, and I just went in and I started designing it for me. And I realized that, that wasn't necessarily what the market wanted in that area. And, so I had to learn a lesson on that one. But so yeah, I take that into account in everything I'm doing now. So it's almost like comping for design.
Yeah.
In a sense, I'm looking at what's selling fast, how many days on market did this one sell, and what did it look like inside? What was the design? What was the kind of theme of it? And because every area is different, and I'm especially finding out in Tucson, it's definitely a different vibe than down here. For the most part. And I don't know if I would call it modern organic, but like it's just kind of that like modern desert feel. It's kind of minimalist a little bit. And that's kind of hard for me, because I just, I want to just make everything look super sick. But that's definitely something to think about. And I think a lot of people, I've heard a lot of horror stories when it comes to that. Like, they get done with it and they're like, I built this house for me. And then it's sitting on the market for a long time.
Yeah. So something that appraisers look at when they're valuing, it's called the super adequacy. It's kind of the nerdy term for it, but it's basically just over improving the property.
Right.
And so the property's a market is only willing to bear a certain amount of renovation in an area. So I see this I see a lot of investors make that mistake, but I see it a lot with homeowners that do live in the property, and then they renovate it, almost like a live-in flip situation where they'll renovate the property, but I mean, they'll just go balls out and like just make the place as cool as they can.
Yeah.
But the market's not willing to bear what they've done to it, and so when they go to refinance, pull their money out of it. For example, I did one over in Augusta Ranch area in Mesa. So
that's where I'm at.
Okay, yeah, it's great area over there in the shadow of Eastmark, tract communities. It's a beautiful location. Mm-hmm. I did an appraisal there, 2,000 square foot house. And they put $400,000 into this house.
Oh, geez.
Yeah, and they were just, I mean, they just went crazy. I mean, it looked like a Paradise Valley like flipped. I mean, they just put so much money into it. And, it's going to not appraise that dollar for dollar amount you put into the property isn't going to. That was probably the worst example of that I've ever seen of over improving an area.
400, wow.
And I always say, if you're going to live in the house and you're going to enjoy it and you have the money to do it, by all means do it. But don't expect to get a return on it when you go to sell. But especially as investors, that's the hardest mindset, because I'm the same way. I involved my wife in it, and she gets excited, and we could do this, and it's like, no, we can't, because here's what the comps look like. And so that's what I help a lot of investors with ARV. That's the big thing I always show them. Like, here's the pictures of the comps that have sold. Like,
Right.
model this. That's what the market wants. That's what the top of the market is doing. Like, don't do more than that. Just do that. You're
Yeah.
probably not going to, the extra few dollars you think you might squeak out on your sell, it
Right.
probably isn't worth
the
putting
risk.
the risk. And so,
Yeah, it's also like kind of on the flip side, because it is a crazy thing, dude. Because like James Daynard.
I don't know.
So he's a like a big time flipper. Like he does. I think he's up in I don't know if it's Oregon or Seattle, just up there. And he's kind of the guy that, and this guy, I think he's done literally tens of thousands or tens of thousands, whatever it is. He's done a lot. But he kind of finds the ones that everybody passes up on because they're just looking very one-dimensionally. Like, this is what the numbers say, this is what the comps are, this is what it is. But he's a guy, and this is where I struggle, because I am kind of a visionary. I like to see, opportunity in things, and he finds things and he just sees a different story, and then he'll get it and he'll just deck these houses out and then turn around and flip them for, million plus. And he sees that. And that's, if I could find any kind of, if you want to call it niche within flipping, it would probably be that. I don't think our market, or at least the Arizona market, really supports that, maybe in some instances, but I think that market up there, I mean, everything's so expensive up there. But so, I mean, that's what I said kind of in the beginning. It's like, that's why I love real estate, because it is so creative, way more than I ever imagined. And that, from one person to the next, this guy could be doing this guy could be doing this, completely different strategies, but they both work.
Yeah.
Whereas this guy would be like, nah, that doesn't work. And this guy would be like, nah, that don't work. So that's what I love about it, man. It's real estate is fun. And even down to, financing, you deal much on that side, understand that world at all?
So most of my business is with financing institutions. So,
Okay.
As far as some of my really good buddies are lenders too, and just from loans I've gotten. So I understand from that degree and kind of what they're looking for from an appraisal aspect. I'm by no means an expert though.
Sure.
In the financing space.
But I mean, even that, I mean, where most people, the average person, and I've had a couple, I don't know if his Instagram is Hard Money Michael.
Yeah.
He's been on here. I love that dude. Great dude. But just so many people just don't understand the options that are out there. Yeah. And, so many people that want to get into real estate, but they only understand the traditional side of financing, lending. And they're just like, I can't do it, or I can't afford 20% down, or I can't, whatever it is. And it's like, there's so many alternatives that most people don't know about. Or like, my taxes are messed up, so I don't have 2 years, or whatever, or I don't make enough, whatever it is. And it's just like, man, there's like options for everybody. Yeah. and everything. And, even people with bad credit. And that's another area that I'm really trying to dive into and understand. And my partner, he's really good with numbers and understands that world better than my mind does. But so I count on him for that. But I mean, real estate is just, it's a sweet world, man. It's just, it's fun. It's exciting. And once you understand it and learn it, the other side of it too is, I mean, you can make so much money.
Totally. I think that's, especially if you're a creative person, I think that's even if you're more analytical, but still want to flex the creative, this whole world of lending. And one of my really good buddies he's a loan officer, but he also does a bunch of non-QM, the hard money type stuff. And I actually did an in-depth interview with him in my community where we just talked about all the different, he's a big investor also. And it just, the way with money that they can get creative is it's awesome. And I think it opens up the world to a lot of people. But the one thing it always comes back to is people are willing to lend if you have a good deal.
Always.
And your numbers are right.
Always.
And so that's what it like always comes back to is, hey, if you have your ARV solid, if you comp this solid, you get it back to like the roots of, hey, do you have a good deal? Is the value there? Did you comp this properly?
Yeah.
The money just finds you. And the way they can get creative with making sure you have the money is
and you're right. The money in a sense, it'll find you, but it's also, there's not very many things out there where, say you have a network of friends that are well-to-do. They have a lot of money. There's not a lot of things out there that they would just be like, yeah, let me throw money at you for this. Like even buying a business, I mean, super risky, a lot of risk. But real estate, see, especially when it's backed by the asset, like you can. So I had a meeting. I was in Tucson yesterday. I had a meeting with a guy, my good friend of mine connected me to. This guy sold 60% of I guess you'd call it, he's in pharmaceuticals. A lot of money. And we just had a meeting with him. One of my companies is doing solar on his house. And we just go have a backyard conversation with him, talking to him. And he's like, hey, whatever you need, let me know. Like, he's like, flat 10%, no points up front, whatever you need, I'll fund it. So he's actually going to fund my 8-unit. It's like those opportunities are everywhere. And to some people, that may be like, what? Like, that's crazy. But it's like, you just start talking to people. If you, like you said, if you have that, the good deal, money's going to find you. So it's like, just get out there, learn how to find deals.
Yeah.
Learn how to find good deals. Starts here, comping, go join this guy's SKOOL course. But that's where it's at. And then, yeah, the money will find you. And just start talking, conversations with people, networking events, and money will find your deals, and you can get started. So, well, that's all I got, dude. I appreciate you coming out. I mean, this was cool. Hopefully we get to know each other more. I think a part of your course, if I'm not mistaken, you're going to do two free comps or something like that. Is that
in the state of Arizona.
The state of Arizona.
I'm licensed, so if you join the group, I'll do 2 free comp pulls for you monthly if you want. And then, so that's anybody that joins in Arizona. As an appraiser, I have to keep a work file of all the data I pulled and stuff. And so it's a pretty big, I normally sell out for $100 or $200 alone. Mm-hmm. It's just pulling comps for somebody. So if you join the community, I'll do 2 free a month. And then then anybody that's in the community in Arizona, if you need appraisal services done, we'll work something out, give you a discounted rate on appraisal services too. But
well, I mean, I'm definitely going to take you up on that for sure. But how can people find you, find your course, all that stuff?
Yeah, I'm Kendrick J. Spencer on Instagram. Should pop up from there. It's probably
and we'll link it too.
That's one of the easier places. And then on SKOOL, if you go on SKOOL and just search "Comping with Confidence," that's my community, and I'd love to have you in there. Lots of fun. Investors in there. A lot of people doing cool things. Rio's in there.
Yeah, man.
A lot of other people doing some cool things.
Yeah.
And then obviously it's a place where you can get feedback on comps. We have weekly comping challenges where you can come test your skills, see how you're doing, get feedback. And then, just availability to me. I love talking with people about this kind of stuff.
Yeah.
So,
well, I mean, I would also say that, jump in there fast because the price is about to raise. So jump in there while you still can get it cheap.
Yeah, it's right now it's the cheapest it will probably ever be, and the price is only going to start going up here.
And like I said, it's too cheap. You should definitely be charging more for that. So because it's great information, great course. Like literally, I'm not all the way through everything yet, but your videos are. I mean, like I've done courses, I've done a lot of that stuff. I understand that world. Super high quality. Like you break it down so great. So definitely check that out. But no, man, we appreciate having you, and looking forward to building a relationship.
Likewise. Thank you for having me.
Thanks, man.
Yep.